Canada just ended 2025 with the economy shrinking, and that could put rate cuts back on the table. Let's get into what actually happened and whether or not this slowdown in Canada's economy is private sector weakness or government-supported growth. If you want clean, data-first read on almost every single StatsCan drop that's relevant to housing or real estate, hit the subscribe button. Okay, here's the headline. Canada's real GDP fell in Q4 of 2025. StatsCan has it at 0.2% on a quarter-over-quarter basis. And the key detail is this. The economy didn't shrink because households stopped spending. It shrank because businesses ran down inventories after building them earlier in anticipation of the trade war when they were front-loading a lot of this stuff. I talked about this on the last couple of GDP prints. So today I want to answer one question that matters for interest rates, for housing, and for risk. Is this contraction real weakness in private demand, or is GDP being supported by government activity? So what actually caused Q4 GDP to contract? Let's start with the mechanical cause. StatCan says the Q4 decline was due to withdrawals of business inventories, is what they state here. After inventories were accumulated in Q3, because a lot of people, businesses met demand by selling stock that they already had because they front-loaded a lot of that due to the trade war and threat of tariffs, instead of producing as much new output. And this matters because inventories are one of those GDP components that can swing a quarter without telling you the whole story of demand. They swung it positively in Q1 and Q3, and now they're swinging it negatively in Q2 and Q4. And RBC's read on this basically says the same thing in a sharper way. The inventory pullback did most of the damage, and they estimate that inventories subtracted about 4.2 percentage points from Q4 growth. So the headline is contraction, but the first filter is, was it demand collapsing or was it just inventory math? And it seems to be a little bit of both. And it's really hard to get a read on, is the economy really suffering with this trade-induced volatility? Now you kind of want to split it into three buckets, okay? You've got households, you've got businesses, and you've got government. So starting with households, your private demand, household spending rose 0.4% in Q4 after a small decline in Q3. So consumers did not fall off, which I've kind of been expecting that they might. Spending rotated towards services and some softness in goods. This is important because if a consumer was rolling over hard, the rate cut conversation would become very different very quickly, and it's not really yet. And nobody really seems super concerned about this print. Business investment is probably the weak spot. So StatCan has business capital investment edging down 0.1% in Q4, but they also flagged declines in both residential and non-residential investment, partially offset by machinery and equipment like computers. And on the housing side, business residential investment fell in Q4 with weaker resale activity and renovations, especially, plus softer new construction, which is going to be a theme for the next couple of years as we start rolling over on housing starts. So if you're looking for organic growth, business investment is not sending that signal. That's not a positive vibe for Canada's economy. Now let's move on to government. And this is where the GDP is being propped up. Criticism gets a little bit real. Statistics Canada is pretty explicit here. Total capital investment rose 0.8% in Q4, driven by increased government investment in weapon systems because we had to hit that NATO target. And for the full year, government investment in weapon systems is up about almost 50% in 2025. StatCan says 2025 was the third straight year where government capital investment contributed more to GDP growth than business CapEx. So to answer your question directly, some of the resilience is absolutely coming from government-led capital spending, not a broad private investment boom. If you want, I can do a follow-up that charts government versus business investment over the last cycle and ties it to what the Bank of Canada can realistically do next. Maybe just hit me with a comment on this video if you're interested. The next piece is the trade war question, right? So StatsCan also says that 2025 ended with a bit of slower growth. We keep blaming this, right? Real GDP rose 1.7% in 2025, and the big drag was lower exports, particularly to the United States. In Q4 specifically, exports were positive, up 1.5%, led by things like unwrought gold and aluminum products. So like the Ring of Fire, a lot of this like diversification of Canada's economy is actually helping us. This is what you get, you kind of get this like choppy pattern that people keep talking about, a lot of volatility. Demand is not collapsing in one clean line. You're getting trade-linked volatility, inventory swings, and a domestic economy that is trying to find a steady gear. The next key question is sort of why do the monthly GDP by industry numbers look better than the quarterly contraction? And this is where people get confused, so let's be crystal clear here. The monthly GDP by industry release says real GDP rose 0.2% in December with strength in services, wholesale trade, transportation, and the public sector aggregate. It also says that the public sector aggregate grew 0.2% in December, and public administration is a key contributor. But the quarterly headline says that Q4 GDP contracted. This can be true because GDP by industry measures production side output, what industries produced. GDP by expenditure measures spending side GDP or consumption, investment, government, trade, inventories, etc. And you also have 2 other months in Q4. And inventories are the classic sort of wedge that can make a quarter look worse, even if the end of the quarter looks better on a month-to-month basis. Also, StatsCan's advanced read says that January 2026 was essentially unchanged and manufacturing was down with real estate and rental and leasing down, which we know, super slow start to the year for real estate, offset by some gains in other sectors. So the start to 2026 is not screaming reacceleration yet. So what about the rate cuts? Because at least one headline mentioned are further BOC rate cuts on the horizon as a result of today's GDP print. If Q4 contracted, that's our second negative quarter of GDP, but the contraction is heavily tied to inventories while household spending and exports were up and government capital spending supported the quarter. So you do have the government almost, you're getting this fiscal dominance that I've talked about a couple of times. The government is keeping the economy stimulated. The central bank may not feel like they need to be stimulative. Business investment is bad or falling or weak. January is pretty flat on the early estimate. This combo keeps the more cuts conversation alive, but it also explains why the debate is messy. You can argue the headline is weak, and you can also argue that the underlying demand, your consumer, isn't collapsing. And so it's a tough spot for the central banks to be in. If you want me to tie this directly to Canadian housing next, especially what weak business residential investment means for supply and construction, drop a comment below and I'll make sure to cover that in the next video. And hit the subscribe button because the next releases that matter are the official January GDP by industry update. I have a couple of, I'm gonna start covering payrolls as well as unemployment, just because I find unemployment is like becoming less reliable. Ben Rabideau put out a chart. Basically, it shows like payrolls and the labor force survey are actually like diverging. I think they're furthest apart that they've ever been. So there's some reporting errors with the nature of the survey that they do for labor force survey. I'm going to break these all down, obviously, in the same way, fast, clean, and with the charts. So this whole thing kind of leaves me with the same question that I've been asking throughout the year. I anticipated that we would see a negative quarter of GDP growth in Q2. I thought Q3 would be negative, but I think the trade war pulled forward a lot of the demand, which is mentioned in the StatCan release. And I anticipated that we would see a negative Q4. So we have 2 quarters of negative GDP growth in 2025, but not 2 consecutive quarters of negative GDP growth. So we don't have a technical recession. And so the question that I want to leave you with is, do you think we'll see a technical recession at any point during the cycle? I mean, we've got, if Q1 of 2026 was negative, then we would have Q4, Q1, and that would be a recession. Or are we going to keep kind of this bouncing? Because we saw this in the 1990s, like you'd get one quarter down, one quarter up. There was no, like, it was a long and slow recession, not a deep and fast one. And that's where the deep and fast is where you get that V-shaped recovery. And I don't know which one I'd prefer. I think that for the consumers, for Canadians who are heavily indebted, time is actually a disadvantage. If you're trying to service debt and there's the monthly cost, that slow bleed is actually far more damaging to Canada's housing sector, to real estate investors, to property owners who are having a harder time on a month-over-month basis because the economy is not growing. And time, a prolonged recession is actually far worse for someone who's bleeding out than, the fast recession of somebody who maybe you cut the arm off or whatever and get to the hospital and get it fixed, get it stitched up. I don't know if that's a good analogy, but economic analogies always seem to be really bloody. Anyway, are we going to see a recession or not? Let me know in the comments. Thanks a lot for taking the time to watch this video. As always, do my best to read and respond to all the comments, and I'll see you again as soon as I can.